Debt to income, or DTI. What is it? How do I calculate it? And why does it matter? In this next video, I'm going to go over all of those things. Hi, my name is Jeff Sheeman. I'm a local mortgage lender in Southwest Missouri. I'm currently licensed in Missouri and Florida. If you're in the market to purchase or refinance, I'd love an opportunity. So, when it comes to debt to income, there are actually two different calculations that we come with: the front debt to income and the back debt to income. I'm going to go over this on the screen here in just a second, but really, the front debt to income is just your housing payment divided by your gross monthly income. The back end ratio, or the back end debt to income, is your housing payment plus all of your other debt payments divided by your gross monthly income. A lot of people get this wrong, and income's one of the most challenging things to do in the mortgage world. So I want to run through it with you real quick so that way you know where you're going. All right. So the first step you're going to do is you're going to go to homewardlending.com. That's my website, and there's a mortgage calculator on there. So this is what it's going to look like. If you want to get some information maybe about different types of loans, whether conventional, FHA, USDA, VA, you can get some information here. But really, I want you to scroll down here to mortgage calculator. When you click this button, it's going to pop up my second website, which has the mortgage calculator actually embedded into it. And so this is where you can just punch in some numbers and see what you think. I've got some numbers here that are just guesstimates. I have a conventional loan. You can also choose USDA, FHA, VA. If you're unsure which one to pick, just go with the conventional one, and then update some numbers and just play around with it with interest rates and purchase price and that kind of stuff. Because we just need to get you into the ballpark, set some realistic expectations of what payments are going to be. So I popped in here $250,000. I did put a 20% down payment. This particular example doesn't have PMI. I just wanted it easier to calculate, but we can play with those numbers and change this at any point. I put a 6.5 interest rate. Homeowners insurance, I guesstimated at $1,800, and then property taxes, I guesstimated at $1,200. So it's important to know that this is everything that you have to pay with your monthly payment. It's not just principal and interest. It's also property taxes, homeowners insurance, maybe HOA dues if you have them, and then also mortgage insurance if you have to pay that. But what we're looking for is a 1514 example here. This is the number that we're looking for. I'm going to transfer this over into an Excel sheet. I don't typically use this Excel sheet. My software does this for me, but I wanted something that you guys could recreate and you could play with. So I have monthly income. Income is the single most challenging thing to calculate in these mortgage loans. We get it wrong. And I know it sounds like it's something that should be easy to calculate, but there's a lot of nuance to this business. So if it's this loan type, this is how you calculate income. If it's this type of income, this is how you calculate it. Maybe it's variable. Maybe you get a lot of overtime. Maybe there's some bonuses. Maybe you're self-employed and you write all your expenses off. Income is always the challenging piece, or the most challenging piece, and usually what causes the most problems with these files. So income you need to pay attention to it. Okay, so either way, monthly income $5,000. Housing payment, I have $1,264.14 for principal and interest. $100 for taxes, $150 for homeowners insurance. Those are the numbers from my calculator. Okay, so your all-in monthly payment is $1,514.14. So to calculate your front end debt to income ratio, I take 1514 and divide it by 5,000, and that gives you 30.28%. Okay. Typical rule of thumb in the finance world is that 30% or less. There are a lot of people that go higher, up into the 40s, just because of housing prices and interest rates and things like that. If you're playing around at the max that we can allow you to, I really want to have a conversation with you and make sure that you can afford this monthly payment and make sure that we're not setting you up for failure, to be quite honest. Okay. So your front end debt to income is literally just your housing payment divided by your gross monthly income. And it's your gross monthly income. So in a situation like this, we're going to say they make $5,000 a month and they work 160 hours in a month. So it's $31 an hour. We want the gross number, not after taxes, not after your health insurance removed and any of that. We want the gross number. Okay. And then you figure your housing payment, whatever that's going to be, and you divide the two. Pretty simple. These ratios are different. Well, the ratio that you're calculating will be the same, but every loan program has a different ratio of what we have to keep under it, whether it's conventional, FHA, USDA, or VA. They all have a version of debt to income that we have to follow and keep you under that limit. It's a ceiling, okay? Now, for the back end ratio, we add in all your other debt payments, things that are on your credit report, car payments, student loans, credit cards. Maybe there's also Klarna, Afterpay, any of those online credit card kind of things that say they don't report to your credit. Anything that's on your credit report, we have to take the monthly payment for it. So I always use this as an example. I had a borrower one time that had a little over $400,000 in student loan debt. She didn't go into the degree that she had an education for. She was doing something different, and she had qualified and applied for a income-based repayment plan. So it was $400,000 in debt, and her payment to that debt was only $5 a month. So all I have to count against her would be $5 a month. Okay. Mortgages, we don't really care about your overall debt to a degree. We care about the monthly payment to the debt. Okay. And that gets missed and confused a lot. So your back end ratio is literally just all of these payments plus your all in housing payment divided by your gross monthly income. Okay. People make debt to income a lot more challenging than it is. Add up the payments divided by your gross income. The challenging part is making sure that you have your income calculation correct, and one that underwriters will approve. So now that you know what debt to income is and how we calculate it, let's start playing with the numbers a little bit to see what we could potentially approve you for, right? To get in the right idea. So let's say we want to keep your back end ratio under 50%. How much can we go up in your payment? Let's say we do a housing payment of $1,600. That's not right. We're going to zero that, and zero that. So we're going to just do, oh, that's why I did it, $1,600. Your back end ratio is at 47.7. So we're going to keep playing with this number until we get, oh, we're over 50. So let's go back down to 1750. Let's go down to 1700, right? I'm just playing with this to get you under 50. So on a $5,000 monthly income with $1,700 housing payment plus all of this debt, that means your back end ratio is at 49.7. So we're under the 50 threshold. But let's say you can't find a house, or the house you want to buy is maybe $300,000 or $400,000 or $500,000. It's a lot higher monthly payment. Well, how can we keep our back end ratio below 50? Maybe we pay off a credit card. Maybe we pay off both credit cards somehow. And now we can move our payment up to 2,000, 2,200. Oh, that's too high. 2,100. 50. See, we're getting closer. 2050. All right, 49.9. So we can play with these numbers up and down. Something else that people realize, or that we can do, is I'm just calculating your total payment right now, but let's pretend like your principal and interest is $1,000. Your taxes are $150. Homeowners insurance is $200, not $2,000. And then HOA dues are $10, and then mortgage insurance is $50. And so we're going to fix this since I messed it up. There we go. So we're at 1410. What if we got cheaper homeowners insurance? Our back end ratio is at 37 right now. Maybe our principal and interest will say is 1,500 because we'll try and get closer to the 50. But we need this to be lower. We need your back end ratio to lower. Maybe we get a homeowners insurance policy that's a little bit cheaper on the premium. Maybe we can shop around for mortgage insurance a little bit and get that a little bit lower. Property taxes kind of are what they are, and then principal and interest. Maybe we buy your interest rate down a little bit to lower this payment. There's lots of levers, or there's several levers that we can pull. Sometimes you can't pay your student loans off or your car payments off, and we just have to deal with those payments. And so then we find cheap homeowners insurance. We buy the rate down. We do whatever we have to do. But you can tell as you play around with these numbers, kind of where you're going to fall. As always, guys, if you learned anything or found any value in this video, consider giving me a thumbs up, maybe subscribing to the channel, and it would really mean a lot to me if you would share this with anybody that you know that's in the market, or maybe a realtor friend of yours. I love educating the mortgage community and the real estate community. Again, go to homewardlending.com, this one right here, start an application, or contact me or my team if you guys have any questions. Thanks, guys, and happy house hunting.